Thank you very much. I mean, in a way, the good news is not too far away from the regional one. At least it's actually is an extension. So, first of all, thanks a lot for the invitation, Guillermo. And let me kind of start straight away. And actually, I'm going to time myself just in case. Okay. And so this is joint work with Roel Beetsma, Jesper Hansen, and from the UvA, and Frank de Jong from Tilburg University. So basically, this kind of project is started almost kind of by chance. We were working on at some point on the determinants of sovereign yields, and news, contagion, and at some point we were kind of starting controlling for a number of factors. And one of these factors that we wanted to we were curious about was kind of auction days. Okay, so for example, you're interested on a 5-year maturity yields, sovereign yields. You try to account for common factors or account for many other factors or news or and looking at contagion aspect in there. And we're looking, we are actually realizing there was a systematic pattern that was coming from auctions when auctions of similar maturity were happening. Okay, so we started kind of wondering. Okay, is there first of all a data set on auctions? Okay, on dates of auctions at a European level and so on. And the answer was there was nothing basically. So, kind of a big contribution, at least up to now. It's basically constructing a data set of auctions, all type of maturities. Okay, here we use just 3 maturities, but we actually have maturities from a few months up to 30 years, of 6 European countries. Okay, which cover basically 90% of the entire stock of sovereign debt in the euro area. So we're talking about Italy, Germany, Spain, France, the Netherlands, and something else. Belgium. Thank you very much. And basically we try to look at how secondary markets and primary markets interact with each other. I mean, just let me give you an intuition straight away of how it works, and then maybe I start motivating a little bit. But I mean, the idea that we kind of, the entire idea of the paper here is that assume that the secondary market systematically reacts to upcoming auctions. Auctions, by the way, are known well in advance, the date. The treasuries publish the calendar a year before. They tell you, okay, in day X, we're going to issue roughly this maturity. They just talk about short run or medium run or long run. But the dates are very well known in advance. And 5 or 6 days, working days before the actual auction, they send a letter to all the primary dealers and say, we're going to issue, we would like you to bid. Okay? And these primary dealers are expected to bid, otherwise they don't maintain the status of primary dealers. Okay? They have to be active. And the idea is that but this primary dealer is actually pretty much not only active in the primary markets, but these are also the ones that are active in the secondary markets. In fact, they're pretty much the same agents. So we find here that secondary market yields systematically start going up to an auction to just fall down to pre-auction level. So, and this is what we call the auction cycle. Okay? And the entire paper is just to kind of quantify, first of all, is to verify whether there is an auction cycle, something that was found in the US just very recently by some guys. So we do in the euro area. We try to see what is the effect of the crisis in the size of this auction cycle. And then on top of that, given that we have a setup of countries, which is not only one, like the literature has been based up to now, we have a set of European countries. We want to see whether there are actually spillovers. There is an auction happening in Spain. Okay, is it going to have some kind of effects on the yields on Italy, for instance? Okay, and what are the factors that might affect this? So this basically is the general idea that we have here. And as I was saying, it's very preliminary. I just sent the first draft to here to my discussion, and to be honest, it's I'm sure there are a lot of potential improvements. But I mean, I basically I told you already more or less, what is the story that we're trying to look at. Now, just let me kind of go back a little bit. I mean, you know very well since the crisis, there's a lot of interest being renewed, and we've seen also this morning on fiscal policy as a macro tool, of debt sustainability, the determinants again of sovereign bonds yields, looking at credit ratings, news, contagion, and we are quite surprised to see that very little was done on the fact of how secondary and primary markets, government bonds, maybe interact with each other. Okay. And this is quite surprising because I remember at least one of the main reasons why kind of Berlusconi had to step down at least a few years ago, okay, was the fear, okay, there would have been a lot of renewal okay, or auctions in a particular year after, the year after, and with yields being high, okay, this would have mean clearly high additional issuing cost, obviously for the debt. Here, these are kind of first level effects, if you want. You know, the fact that the yields are going up, the secondary yields are going up, represents like a benchmark for the yields or the bids they're going to offer in the primary market. Here we're talking about kind of second order effects. Kind of you go a certain dynamic in the yields, it might come from fundamentals. Here we have some systematic short run effects within a window of 10 days, which is what we actually find here. And this kind of second order effects, if you want, adds on the issuance cost. Okay, when we talk about that is the main idea. So we kind of request the president, just to give you an idea, this is kind of, you have plenty of these quotes, at least from the financial newspaper. This, for example, was something in April 2012. Italy's borrowing costs are under pressure to rise further, bond sales next Friday. So this already tells you that basically it's five days before. Then people know, or primary dealers know, that there's an auction happening. Investors are kind of getting nervous. They want to see how it's going to perform, the auctions, of course. And basically here they call it as a risk event, okay, for the entire financial markets. And what we actually here, what we're trying to look at, as I was saying, is precisely these particular questions. First, I told you about, we constructed a new data set. As you might expect, it took a lot of time. This basically, it's really almost one-to-one. If you try to download this data from Bloomberg, they don't give you a nice kind of time series they give you maybe some dates, some data on the performance of the auctions, and actually you actually have to double check with the Treasury documents, because the ones that actually Bloomberg provides, most of the cases are not even super precise either. So here there's been a lot of work on, starting from Bloomberg on the days of the auctions, and then double check with the Treasury offices precisely whether these auctions were kind of correct. From 99, so from euro, up to now. So here we're talking about also spillovers, we don't worry about exchange rate risk and so on. Just, we're talking about the same currency. We explore, first, the presence of these domestic auction cycles that I told you about. So how secondary market yields movements move around an auction, just before and after. And we take generally a window of 10 days, 5 days before, 5 days after. But if you extend it, basically, the results are really there. Most of the action happens within this window. We study also the present, given that we got the fact that we have more than one country, of whether there are spillovers, okay, as I was saying earlier. And this, to our best of our knowledge, basically there's nothing on that has been done before. I mean, as I was saying, it's a very first try, and I hope that I will get also some comments. In fact, I don't know if Guglielmo, I'm going against the mainstream. I've been in the second presentation here in the afternoon, kind of really with testing the sleeping kind of a strength of the audience. I mean, I'm quite happy to get questions in the meantime. I don't know whether this goes against some principles. Okay, so feel free to kind of interrupt me anytime in case it's not clear, at least to make it a bit more lively. Now, and then again, we end up with something that's quite interesting. Of course, there are some implications of that. If I had the time, I would talk about the policy implications that. One of them, I already anticipate, might be, okay, suppose that you find this cycle that's systematic, and you find that these cycles are actually quite strong during kind of intense crisis periods or turbulence in the markets. Now, if the agencies have some degree of freedom, okay, to actually choose a different date, or at least maybe they have some time, or they might be advisable to time in a different way the auctions, okay, if you got obviously the flexibility to do that. Also, when you think about the presence of spillovers, if you know that the fact that there is an auction in another country, there has effects on my own secondary markets, and during the same period also we auction ourselves, maybe, okay, might be a good idea if the treasuries maybe coordinate with each other a bit more, okay, to avoid this. Something that, by the way, to our best of our knowledge, again, doesn't happen. Each one has got his own calendar, okay? So these are there are clearly positive implications on that. And why? Because, again, the presence of this cycle implies additional issuance cost. That's the point. The yield secondary market go up. That represents the benchmark for the auction bids that the primary dealers are going to post on that particular day. And then the fact that it goes down back to baseline, fine. But the fact that it's gone up, at least for half of it, implies additional basis points cost on the bids that you have. And the average bid that is going to be accepted tends to be higher because of this kind of second order effect. So these are how we calculate the issuance cost. Okay. Now, so what we find in this paper? Okay, we find evidence of domestic cycles. This, in a way, it's extending the original paper that we discussed earlier. And in a kind of course, these 6 Euro countries, this cycle is not as sharp and clear as for all of them, but in general, there is a clear pattern in that. In the case of Italy, it's very clear cut. In the case of Spain, it's very clear cut. In the case of other countries, Belgium as well, is very clear cut. In others, it might be kind of a bit more, kind of less statistically significant. So, the domestic cycle tends to be larger during the crisis. This is one of the main results that we find. So at some point, we interact the size of this cycle with some measure of volatility in the bond market. Okay, and that kind of so if you want, we add some kind of non-linearity in the size of the auction cycle. But again, on average, the effects can be up to 20 basis points. Okay, which is not trivial if you think about a 10-year bond or even a 30-year bond. Okay, something that you have to roll over yearly at a higher kind of yield for the entire maturity of the bond. This turns out to be kind of a million kind of cost, additional cost for the treasuries. We also find evidence of domestic cycles in response to foreign debt, okay, which is the main focus of the paper, although these effects tend to be smaller than the domestic, okay, which makes sense to some respect. And, but strangely enough, okay, these spillovers are much stronger in the pre-crisis period than the post-crisis period. I mean, I say strangely enough, but in fact, it's not so strange because in the post-crisis period, when I say post-crisis, think about roughly June, July 2007. In the second period, when we actually look at the kind of the degree of integration of the bond markets has reduced quite dramatically. Okay, it's become a little bit more segmented across the European countries. So the fact that you find less spillovers, okay, in the second subsample actually makes sense. And this is also one of the main results we want to stress up to now. So the structure of the paper, I don't know what is going to be even the structure of the presentation, is the following. So it starts a little bit with some ready literature. There is a conceptual framework. We take a very small theoretical model, which in a way we use also before, that actually gives you some kind of easy to understand implications of what kind of effects you want to expect as a result of an auction in your own country and auctions from another country. Then, in the paper we describe the data set. And then we start a very simple event study. Okay, this is, you go the date, we see what happens to the yields just 5 days before and 5 days after. Okay, and then, of course, an event study is also kind of a very raw tool. Above all, if there are some other things happening in the window that you have in there. For instance, auctions in another country, and that's why we go and we start relying on a regression analysis. Still very simple, okay, where we regress yields on a bunch of forwards and back dummies, okay? And then we test the size of the auction, then we conclude, and so on. So the literature I was saying is very limited. On this particular secondary market yields movements, and on the days around the auctions, there were only 2 papers. This actually was still, when we were starting working on that, was still kind of a working paper side from the US, where they found this cycle from the US. And this is when we started, okay, working on or extending the data set, at least in the Euro context, but stressing very much the role of the crisis, okay? Something that wasn't that too much here. And here what we find something that's similar to what they find from the US, but again, we find that the crisis played a particular role in the size of these cycles, and it can be quite significant. In the case of Italy, it's dramatic. Okay, in the peak of crisis, you can have that the cycle might be even up to 120 basis points, okay, which is quite dramatic. Now, there's also a literature on the determinants of sovereign yields in the euro area, again, which focus mostly on country risk and liquidity. And there's a literature on integrations of these markets. Again, something that is related to what we're interested in, because when you talk about spillovers, clearly you also want to see what is the degree of integration between the markets that you're analyzing. And then, of course, there's also the issue of the kind of contagion, and those papers that look at mostly how the linkage between sovereign and banking sector is a source of cross-section contagion. I mean, remember here again, we're talking about the sovereign market, but these bonds are mostly bought by big banks. Okay? They in many cases are even overlapping in terms of primary dealers among all the 6 countries. So we're talking about, for example, Barclays, Deutsche Bank, and Citigroup, HSBC, Societe Generale. So these are all primary dealers that operate very actively in all the bond markets, in the primary markets. Now, first question that you might want to ask is, I mean, first of all, why should you have any effect whatsoever in the yields going up? There are some kind of effects that have been put forward by the literature. For example, just very intuitively, I don't want to go through all the others here, at least the first 2. I mean, for example, the fact that there is a new issuance of bonds, provided that there is no full redemption, so the supply actually goes up. Okay, this has a negative effect on the price, and as a result, okay, positive effects on the yield. Okay, that is kind of the most obvious story. Then there are also some other stories that have to do with the fact that you go from an off-the-run or on-the-run bond. The off-the-run is less liquid or less kind of attractive also in the repos and so on. And there's also other aspects that have to do with the maturity effect. But all these effects somehow predict, at least from the literature, that there should be some kind of persistent or even permanent effect on the price, not a reversal. Okay? There is instead kind of this other approach that we're talking about here, which is the limited risk-bearing capacity effect, which is precisely the story that works through the primary dealers. And the fact that risk-averse primary dealers are kind of participating in the auctions and also being the ones that are also participating very much in the trading in the secondary market, need a compensation for the fact that they take inventory. So I'm a primary dealer, okay? I had to put some bids. I got some customers, big hedge funds, corporation, whatever. They tell me that I have to buy a certain amount. I order it, I participate in the auction, but then I keep these auctions, these bonds, in my portfolio in the form of inventory for some days. So obviously, okay, I'm going to run some risk in terms of price. Okay? Interest rate might change, there is a volatility during these 2 days. So the main idea here is that the higher is the inventory risk that you take, okay, and the more you want to be compensated as a primary dealer, so the more you're going to end up bidding higher yields in these auctions. Here is the model that I was mentioning you. Again, I mean, I'm not going to go through, but this is just borrowed completely from a Holland-Stoll model in '83, which is just kind of the oligopolistic dealers, maximize the mean variance utility function. This is the price of one of the assets that you can think about maturity 10 years for Italy. This is a fundamental value, which we don't know, and this basically has to do with total absolute risk aversion, A, and then kind of your portfolio here, and you go here, there's a covariance term that tells you what is the covariance of the rate of return on my J to any other asset that go in the portfolio. And this is the inventory, the amount of the other asset that I have, okay? So when you kind of solve this, you come out with some implications which tells you that in upcoming auctions, so the other asset could be an auction, our asset could be the asset I, could be such that there is a leading positive effect on the price, on the yield, and as a result also on the price. This model also tells you that the larger is the auction, so is the larger is the size of the inventory this primary dealer takes, the larger will be the above effect. They also tells you that the more integrated, or the larger there is a sensitivity degree between the two assets, the larger will be the effects. So it's this covariance term that I was showing earlier. And then there's also this model tells you also something about the crisis. What you could expect these predictions to be affected by a crisis period. During the crisis period, maybe you can expect that the risk aversion A goes up, okay, which is something that appears here in the degree of response of the price to an auction that comes. And could be also that the variance of the assets itself might be going up, okay? So all these effects work on increasing the size of the auction cycles. But then there's also, could be the fact that the crisis reduce the degree of susceptibility between the two assets. In that particular case, this works on the other side. And this seems to us like the effect that explains why the spillovers are reduced in the crisis period. So this kind of susceptibility between the assets are kind of is much lower in the crisis period. Now the data set I already mentioned. I just want to stress that we look only at three maturities: 5, 10, and 30. We could have taken also others, but these are kind of the ones that are more standardized, or if you want, they're common. They're kind of regularly issued by all 6 countries. In the previous papers, we were looking at a 2-year, but the effects were exactly very similar. So all these can easily be applied for different maturities as well. But just we look at these 3, they're pretty standard. And again, we just use only a subset of this information. In fact, here, we got auction data for these 5 or 10, 30 years, but we have it for all maturities, okay? And for each, we look at the auction date, the total amount allotted. So basically, is the amount the Treasury announced 5 or 6 days before the auction. And then how also the auctions performed. So in terms of how much was demand that was posted. So out of that, you can also get a bid to cover ratios. And also the average accepted yield, which is actually what the Treasury is going to pay exposed. But here in this particular paper to now, we mostly use the date and sometimes the size, the allotted value. Here there are just some statistics on these auctions. And, I just want to stress that we are analyzing for these 3 something like 1,600 auctions, okay? And the 5 and the 10-year auctions are much more frequent, as you might expect, than the 30-year auctions, okay? In fact, the 30-year auctions in some cases, actually quite relatively used in Spain, okay, and in France, but very little, in Italy as well, very little in the Netherlands, okay? We are only 11 in entire window of 15 years. This is something that I think is interesting. You don't have to look at the numbers, but here we look at the degree of integrations of these markets. So starting from the yields in the secondary market. We are interested in how integrated they are. Just we take this term, which is the standardized covariance of daily yield changes here, that appears also in the theoretical model. And you see whether we actually notice that in the pre-crisis period, so pre-June 2007, the amount of these the standardized covariances of daily yield changes are quite high, of the order 0.91, okay? And when you go into the post-crisis period, they drop quite dramatically. So the markets, if you want to become a bit more, less integrated with each other. And again, this kind of is something that in a way was useful to us also to justify, also to interpret, the size of the spillovers that we find later on. Now, first thing that we do, as I was saying, it's just an event study, okay? And we just look at what is the average of the yield at time t, where t could be 5 days before, up to 0. 0 is basically on the day of the auction, and t +1, +2, +3, basically t has to do here with the days after the auction. 0 is the auction date. So we look at the average of this, we plot this, okay? We do it for for a window of 10 days, 5 days before, 5 days after, okay? And what we find here, it's something like, just to give you an idea, a typical inverted V shape, okay? So the yields, you don't see the numbers here, but it's something like of the order of 6 basis points. So 5 days before the auction, okay, the secondary yields are 6 basis points below. They go up, and after that, they go back more roughly to baseline. So the entire cycle, the way we define it here, is this plus this, the entire movement of the cycle. A movement upwards and a movement downwards. This is how the literature calls an auction cycle. And we find this is the most clear cut in the case of Italy, but again, you can find also very similar things, at least although from a statistical point of view, you have to be very careful, like in Belgium or in Spain, mostly, sometimes before, not necessarily after, and in other countries like here, the Netherlands or France. Again, it's in some cases, the statistical significance is not pure, but it's not very precise, but it's still it's in there. Of course, with the event study, you can also do now the event is not the actual domestic auctions happening, but it also might be a foreign auctions in the same maturity happening. And it's basically it's a similar exercise, but where now the event is happening over foreign auctions. And again, here we found numbers which are kind of consistent, at least up to this stage, of presence of spillovers, something that we test much more, in a more systematic way later on. Now, why do we do that? Why do we do it in a more regression analysis? I mean, you know that in event studies, I was saying earlier, you go compounding effects, okay? Also in the window of 10 days, many other things can happen. Also, precisely the events that also you're interested in, which would be maybe auctions, or the same maturity happening in other countries. So that's actually is a big drawback that kind of deserves, at least to test, to try a regression analysis. And the regression analysis is extremely simple, at least the baseline, and then we start opening up these terms here. You got the change in the yield. Think about the change in the yield of country I, Italy, M, maturity 5 year at time t. Okay, these are daily data. And basically here we have a set of auction dummies, 0, 1, okay, 5 days before, 5 days after. Okay, the fact that we use the growth rate here means that we use 4 days before and 5 days before and 4 days forward here. But it's basically this is actually we do it. And what we do here in the regressions that you're going to see, we just look at these parameters, this alpha. This alpha should be all positive, or at least we expect it to be positive because the yields are going up in the pre-crisis, in the pre-auction period, and then negative afterwards. So it's the symmetry up to the auctions or the alpha minus all the negative values of that. And we test for this to be equal to 0. It should be equal to 0. Okay, so we do a simple F test, okay, on that, and we see what is the size of the auctions and whether it's statistically significant. And this, for example, is what we get here. Okay, and I want to kind of stress too much the results here. I want to just summarize them. So the regression that we have here regarding the auction dummies are in line with the results of the event study. Even when we control for other auctions, we don't do, by the way, up to now, but we do it later on. Also, when you control for auctions in other countries, the domestic auction size is always very robust and remains in there. Now, the domestic auction cycle tend to be larger in the crisis period, okay, with the exception maybe of France. When we split these kind of regressions in the pre-crisis, pro-crisis, we find they are much larger in the crisis period, again, with the exception of France. And also something that I haven't shown too much, but the auction cycle tends to be symmetric. So we test a significance, or if you want, where this upward movement is statistically different from the downward movement. Okay, this is very important just also to see, because this actually is one of the key results that might distinguish between the model I'll tell you about, the primary dealers model, okay, the inventory model, and the other three effects that instead, from a theoretical point of view, predict a permanent effect. Maybe a just upward movement and you remain there. Here instead we always have there is a mean reverting. Okay? And again, when we test for symmetry, we don't show it. It's in the paper. Kind of we show that it's actually in there. Now, with the regression analysis, we also do much more than that. Okay? Here, up to now, we just use a simple dummy. Auction here is 0, 1. But of course, why do you use a 0, 1 when you actually have the size of the auction? So you can do that, and this is what we do. But it results very much in that. And of course, the interpretation is a bit more direct, because at the point you also know that 1 million extra of auction, billion, okay, might imply, for instance, a direct effect on the auction cycle. So you can, in terms of interpretation, using the size, it's advisable. But here, kind of, up to this moment here, we mostly work with dummies. So we do that with the auction size, I was saying, and the results are pretty much unaffected. But we also can do much more at that point. For example, one thing that we do, okay, is that, okay, now, why don't we interrupt, okay, this auction cycle with some measure of stress in the markets, okay? And what we take that as a measure of stress, as we did in the previous paper, we take like the standard deviation or the 30-day moving standard deviation of the period before, okay, an auction happens, okay? So it kind of gives you an idea of how turbulent, volatile the bond market is. And we see, okay, we try to test whether, okay, the size of the auction is a function of the volatility, because that is the idea, okay, without going to, and we test that, and we find evidence of this in this respect, which is also consistent with what we found in the previous paper, okay? Again, this is something that we do that but of course, another way of doing it, okay, another way to extend this is precisely to go towards the direction of where we're starting from the very beginning. We're not mostly interested in the auction cycle domestically, but we're also interested in whether there are also other auctions in other countries. and we want to see if this equivalent of alphas here, okay, when there is an auction from another country, are going to affect the domestic yields. Okay, this is what we extend this baseline regression with. And the results are here. Okay, let me see. So basically here, you cannot read it, just the first part is basically the regression that I just showed you, augmented with a auctions dummy every time there is an auction of the same maturity in any of the other countries. Okay, so here we took basically an aggregate approach. We just want to see how these aggregate spillovers, of course we want to use more information as possible, but later on we also do it on a bilateral framework. So basically what we do here, we just look at the size of this foreign spillovers, okay, and we see also if the domestic spillovers or the domestic cycles remain in terms of significance. What we find, and actually it's very much here, this is the full sample, this is a pre-crisis sample, and this is the post-crisis sample. These lines here that you see here, they're also always very statistically significant, okay, at all maturities, are all the terms coming from the spillovers. So in the pre-crisis period, these spillovers coming from the foreign auctions are always there, okay, strongly so. In the post-crisis, it's still in some cases kind of significant, but much less so, and also in terms of size, reduced. And this is basically what I want to kind of summarize out of the previous speeches. So controlling from foreign auctions, the effects of domestic auctions are essentially unaffected, okay. We find that the strong evidence of domestic auction cycle arising from foreign auctions activity, and these spillovers are smaller than in the case of domestic debt issues, okay. Now, also consistently with this lower degree of susceptibility that I told you about earlier, about the standardized covariance, okay, we find that these foreign spillovers are mostly significant in the pre-crisis period, where there was a lot of high degree of integration in the markets, much less later on, okay. And of course, someone might ask, but what are the sources of these spillovers? In a sense, here, okay, we're just looking at a foreign auction whenever it happens to the other 5 countries. Okay, but maybe we want to see whether is it one particular country or a group of particular countries that dominate these foreign spillovers. And basically, in order to do that in a more kind of relaxed and flexible way, just to use bilateral regressions. Basically, what I say about bilateral regressions is that we augment. Suppose again that this is the Italian case. Okay. So the auctions in Italy and the auction in another country. And we do all of this bilaterally, one by one. Okay? In one case, the other country J here could be Spain, the other country could be Germany, the other case can be the Netherlands, and so on. And this basically is a summary of the size of these betas here. Okay? And again, without going into the specifics, this is done for the 5-year maturity, this is for the 10-year maturity, and this is for the 30-year maturity. A careful kind of observer can see already that the stars are actually mostly happening, okay, in the longer maturities, which is actually also what we find here. The most of the spillovers are happening mostly at longer maturities, 10, 30 years, okay. Again, this is just a repeat of what I said earlier now, consistent with the low degree of sustainability, the spillovers are prevalent mostly in the crisis period. And when you actually shift or you move from you do this bilateral regression from a pre-crisis period into a post-crisis period, you find also that the number of significant spillovers drops significantly, okay, from 29 to 30, so it's completely kind of halved, and also in terms of size. There are some exceptions, okay, out of this bilateral, and Italy and Spain seems to have an effect on the other countries pretty much all the time, or at least most of the time, okay? Now, just tell me, before going to the conclusions, I might be even earlier, I don't know, it's... yeah, more or less on time. Yeah. Oh, perfect, I mean, it would take 1 minute. So basically I was saying here, of course, finding these spillovers or finding these size of auction cycles per se, okay, is interesting, seems like a systematic pattern, to the point that actually you can even say as an investor whether there is a kind of extra profitability that traders can actually make use of, okay? This is something that, by the way, we test in the previous paper, and once you account for actually transaction cost and anything, there's not too much kind of that you can make profits from. Still, from a treasury point of view, might be interesting to see whether, what are the additional cost. Okay, and here we do some examples in the paper, some back of the envelope calculations. And to give you an idea on intuition how we do it is the following. Take, for example, a 30-year Italian bond, okay, for the full sample. Now, the average, okay, size of the auction, or this 30-year is a 1.5 million, okay? Now, we know that the size of the auction cycle, in this particular case, is 6.80, 3.40 going up, 3.40 going down, okay? So let's say, okay, let's assume that the yields are going up by 3.40 basis points. And this extra 340 basis points represent the benchmark that primary dealers use when they put the bids on the auction day. Out of that, we can calculate it, we can multiply this from the size of the auction, and you can figure out what additional cost in terms of interest payments, okay, the Treasury pays year by year. And of course, this is 30-year. Once you actually look at the duration, you can actually look at for the entire maturity of the bond. And in the case of one bond only, we can even talk about something like 8.6 million. Okay, that's just the one coming from the domestic. Okay, additional issuance costs coming from the domestic cycle. But then, of course, the other thing is that, okay, let's suppose that actually the Italians are auctioning more or less at the same time when the Spanish are auctioning. And we know that Spain might have effects, okay, on the secondary market yields. And as a result, also on the bids the primary dealers put on the Italian auctions. What would be the additional cost coming from these spillovers? And again, this is what we quantify, okay? And can be kind of up to 6 million, which is lower than the 8.6, but so the main point that we want to make here is that these are not trivial. Of course, we're not talking about billions, okay, but we're talking about a lot of additional servicing costs just coming from something which is really systematic. And it's just on average. Of course, in the peak periods of the crisis can be much higher than this, okay? So this is basically what I want to conclude with. We find evidence of domestic auction cycles in response to new debt issues in a set of European countries. This set of European countries, as I was saying, I want to repeat, is represented 90% of the entire stock of debt. The domestic cycle tends to be larger during the crisis than before the crisis, and the effects can be up to 20 basis points on average. But when you even within the crisis period, when you actually look at the peak of intensity, the crisis can be much higher than that. This is what also we comment upon. We also find evidence of these cycles coming from foreign debt issues, although they are smaller than the domestic issues, okay? And they are mostly prevalent in the pre-crisis period, which is consistent with a higher degree of integration of the bond markets in the pre-crisis. Then we do some back-of-the-envelope calculations that we show that these additional issuance costs can be quite significant. So in a way, again, the policy implications of that are clear-cut. I already mentioned from the very beginning. Maybe as a treasury, if I know that basically there is a period of turbulence and I got some flexibility in actually issuing, let me wait, okay? Because there might be some kind of systematic pattern on that. Also, if I know that there are some auctions actually happening at the same time in countries where there are spillovers, maybe we should coordinate a little bit more, otherwise we end up actually hurting each other, okay? So we should internalize these effects. So this is basically some of the. Of course, this is just the first attempt. We can do many other things out of this data set. One of the things that we're working on right now, just to anticipate, is that we got issuance for all the maturities. And the treasurers have the right, have the power to decide how much to issue and at which maturity. The treasurers only say when there will be an auction and what will be roughly the maturity. So they say short run. Or they talk about medium and long run, but they don't say whether it's going to be 2 years or 30 years, okay? So there has some discretion on deciding, depending on the conditions, okay, how much to put in the market and which maturity. So basically, it would be interesting to see kind of in the debt management of this treasury, what would be a reaction function. So you see what's happening in the market, fundamentals, in other institutional aspects, and how these treasuries kind of respond to these conditions in setting their own optimal maturity structure, okay? So this is something that we're working on, and I conclude here.